The call came at 3:12 a.m. Washington time. No warning, no escalation, no negotiation. Just a single message moving through global banking infrastructure like a silent fault line. Access suspended pending sovereign compliance review. Within 72 hours, 47 of America's most powerful corporations discovered something they had never considered possible. They were still operating, but they could no longer move money. At first, it looked like a routine banking delay, a failed transfer, a temporary compliance flag, something that would resolve itself by morning. A payment to an overseas supplier in Germany did not go through. Then another to Singapore. Then a larger one to South Korea. By sunrise in New York, finance departments across Fortune 500 companies were already on their third attempt to reroute transactions through alternative banks. But every path led to the same result. Rejected, not delayed, not under review, rejected at the infrastructure level. By 8:40 a.m., internal emails started to repeat the same phrase across different companies, different industries, different continents. Swiss correspondent access unavailable. No one understood what that meant at scale, because Swiss banking was never something most executives thought about directly. It was invisible by design. A background system, a neutral layer that connected American companies to the rest of the world. If a U.S. company paid a supplier in Vietnam, the money often passed through correspondent accounts in Switzerland. If an investment fund rebalanced holdings in Japan and Europe, settlement routes often depended on Swiss-cleared liquidity channels. If a pharmaceutical company bought raw materials from India, trade finance frequently flowed through Swiss-linked credit systems. It was not optional infrastructure. It was assumed infrastructure. And now it was gone. What had looked like scattered payment failures became a synchronized pattern across continents. Finance teams in different companies, who had never spoken to each other, began describing the same experience in different words. A transaction would be initiated normally. It would pass internal checks. It would pass domestic banking verification. Then it would reach the international layer and stop. No rejection from local banks. No error from corporate systems. The failure happened one layer deeper, in the invisible corridor where currencies change hands across borders. That was where Switzerland existed, not as a country in this moment, but as a gatekeeper node inside global financial plumbing. At UBS Zurich, internal dashboards showed what outside observers could not see: a surge of flagged transactions involving U.S. corporate entities, not blocked outright, not frozen permanently, but placed into extended compliance review queues. The official classification was neutral. Enhanced sovereign alignment verification required. It sounded bureaucratic, almost harmless, but its effect was absolute, because once a transaction enters that queue, it leaves the real-time financial system. And global commerce does not wait in queues. It moves. By 10:18 a.m. in New York, a major pharmaceutical manufacturer escalated to crisis status. 3 international suppliers in India had suspended shipments, not because of payment refusal, but because payment guarantees could no longer be confirmed. In global trade, trust is not verbal. It is guaranteed by financial instruments called letters of credit, and those letters of credit, in many cases, were routed through Swiss correspondent systems. Without verification, suppliers simply stopped shipping, not out of fear, out of protocol. No guarantee means no shipment. No shipment means production stops. At the same time, an investment fund managing over $60 billion attempted a routine portfolio adjustment. Sell Japanese equities. Buy European bonds. A standard rebalance. But settlement required cross-currency conversion, and that conversion required correspondent banking clearance, which now sat in Swiss review. The fund manager described it later as watching time freeze on a screen that still updates. Trades could be placed, but not completed. Exposure changed on paper, but not in reality. By afternoon, the language inside corporate emergency calls began to shift. At first, it was technical: routing delay, settlement failure, clearing issue. Then it became uncertain: liquidity blockage, cross-border restriction anomaly. Then it became blunt. We cannot move money internationally. And finally, in one recorded exchange that circulated internally across multiple firms, a CFO said, "This is not a banking problem. This is access denial." That phrase triggered immediate silence in the room, because it redefined the situation completely, not as error, not as delay, but as removal of capability. By nightfall, the scale was no longer hidden inside corporate systems. It was beginning to surface in economic indicators. Delayed settlements accumulated. Trade financing approvals slowed to a fraction of normal volume. Foreign exchange liquidity in certain corridors tightened noticeably, and risk models across multiple institutions began flagging the same anomaly: systemic cross-border settlement degradation involving Swiss-linked correspondent exposure. No one had a historical template for it, because nothing like it had been done at this scale before. Not through force, not through sanctions, but through controlled access to infrastructure that everyone assumed would always remain open. And in that assumption lay the vulnerability that no one had priced in. In Ohio, a precision manufacturing supplier for aerospace components received a system alert at 6:12 a.m. A routine international order from a major aircraft producer had been suspended, not canceled, not delayed. Suspended due to payment settlement unavailability. The order represented more than half of the company's monthly revenue. The factory floor did not stop immediately. Machines kept running. Workers continued their shifts. But within hours, supervisors were instructed to slow output, then pause new material intake. Because production without payment confirmation is not production. It is risk accumulation. In South Korea, an electronics supplier that shipped critical avionics components to U.S. firms reported a similar instruction. No confirmed settlement pathway, no shipment. Contracts that had been stable for years were now paused at the financial layer. Not because of politics directly, but because the system that guaranteed trust between buyer and seller had been interrupted. At the center of this disruption was something most executives had never truly studied in detail: correspondent banking. It was never visible on invoices, never mentioned in board meetings, never highlighted in quarterly reports. But it was the quiet mechanism that allowed money to move across borders without friction. And Switzerland sat at one of its most important junctions, not as the only node, but as a stabilizing hub that connected dozens of financial systems together through neutrality-based trust. When that hub changes behavior, even slightly, the entire network reacts. By mid-morning in New York, internal war rooms inside multinational corporations were fully activated. Screens displayed lists of blocked or pending transactions, supplier payments in Asia, currency conversions for European operations, credit line utilizations tied to international inventory settlement instructions, waiting for clearing confirmation. One analyst described it as watching global operations turn yellow on a map, then slowly stop updating. Yellow meant pending. Pending meant uncertain. Uncertain meant paused. And paused in global commerce quickly becomes stopped. We are operational domestically, but non-functional globally. That distinction became the core truth of the crisis. At the same time, the financial markets began adjusting, not collapsing, adjusting. Because markets respond not just to loss, but to predictability of loss. And what they were now seeing was a new category of risk: infrastructure dependency risk. Companies were not being punished through traditional mechanisms like tariffs or sanctions. They were being separated from the systems that made international activity possible. Quietly, legally, and at scale. By evening, pharmaceutical supply chains began showing the first visible consumer impact. Not shortages yet, but early warning signs: delayed restocking in pharmacies, extended fulfillment times for prescriptions, temporary substitutions for certain imported active ingredients. The system had not broken. It had slowed at its most critical junctions. And in global healthcare logistics, slowing is often the first stage of shortage formation. In New York, Risk desks across major institutions began running the same diagnostic question in different forms. Is this temporary? The answer kept coming back the same way. No one could define a recovery path, because nothing had technically failed. There was no broken system to repair, only a removed pathway to restore. And restoring infrastructure access is not like restarting a server. It requires policy reversal, regulatory coordination, and trust reinstatement across sovereign systems. By mid-morning, equity markets began to reflect the uncertainty in a way that was no longer subtle. The affected 47 corporations were not collapsing individually. They were being repriced collectively as operationally constrained entities. Analysts began using a new phrase in internal notes: cross-border execution discount. It meant something simple. If a company cannot reliably move money internationally, its global revenue is no longer fully accessible. And if revenue is constrained, valuation must adjust. At one major investment fund, a senior portfolio manager stared at a screen showing frozen settlement instructions across multiple currencies. He described it later as owning assets in motion that could no longer move. Positions were still listed. Returns were still calculated. But the ability to rebalance risk in real time had stopped. Japanese exposure could not be reduced. European exposure could not be increased. Emerging market positions could not be adjusted. The portfolio had become structurally locked, not by choice, by settlement dependency. In corporate headquarters across industries, a new category of emergency meeting emerged. Not about sales, not about production, but about liquidity continuity. Because liquidity is not just cash, it is cash that can move across borders at speed. And speed had been interrupted. By the end of day 4, global markets were still functioning on the surface. But underneath, a parallel reality had formed. One where certain companies could no longer execute the most basic function of globalization, moving value across borders. And as that realization spread, analysts began to converge on a single uncomfortable conclusion. This was not a temporary disruption. It was a demonstration of structural leverage, and it had already been executed.